Good afternoon, everyone. It's 3 o'clock and we're going to go ahead and get started. I'd like to welcome you to People's Company's Big Questions in Land Management webinar. My name is Dave England, and today we're going to be talking about lease terminations, conservation pays, leading harvest, and ending up with our cash rent and market updates, which I'm sure everybody's going to be very interested to hear what's new coming up for 2022. So these are very important topics and timely topics as we start to think about next year. So as many of you know, I'm Dave England, and I've recently joined People's Company as Director of National Accounts. I have long admired People's Company, their business model and their thoughtful approach about managing properties and maintaining close and deep relationships with their clients. So I spent 34 years with Farmers National Company in many roles, and most recently as president and CEO. And since I retired, I soon came to realize after a couple of months that I still had a strong passion for the farm management and real estate business, and his desire to continue serving agriculture and non-resident landowners across the nation. And that's why I've started working with Steve and the team at People's. So, well, that's enough about me. Let me tell you a little bit about People's Company and what we have to offer you. Right now, People's Company is comprised of 4 different separate divisions that help you manage your land investment. There are our real estate brokerage division, our farm and ranch management division, and our appraisal and investment divisions. Today, we're going to be strictly focusing on our farm and ranch management division. So for information on our other divisions, please visit our website at peoples.com. So as we move forward with the farm and ranch management company, we just want to let you know that People's Company does take a little different approach to managing farmland, and they do so in a really sociable and sustainable responsible manner, dealing with environmental issues being directly addressed with regenerative farming and all of those things. So they're the first private asset management company in the country to be certified to manage farmland according to the leading harvest standard. Peter Isaacson, one of our farm managers, will be speaking more on this topic later in the webinar. People's Company managers continue to be the boots on the ground for non-resident landowners. We visit your farms and keep you informed via phone calls, emails, detailed annual and summer reports. We provide actual to budgeted financial performance reports. We do drone aerial imagery for you, not just to take pretty pictures, but to actually analyze the property and make sure that we can find any problems that might be happening in the property in places that we can't physically walk to or get around the property in a time efficient manner. It identifies how the crop is progressing. We also look at different soil issues. We look at capital improvements, from tiling improvements to building grain bins, irrigation development if needed. We also work on production and yield performance for the property to help improve your yields and provide good yield history. As you all know, what you have is a very valuable asset that basically looks at, we rent for you and through you production. And the higher production that you can get off of your property, the better profitability that you can make off of your farm, as can your farm operator. So we want to make sure that all of the fertility reports are in our files, made sure that the fertility history is kept up to date. We also are looking at lease status updates, where we can do lease amendments on different things from fertility to hunting leases, anything like that. We are having Kathy Law talk to us about lease terminations today. Again, hunting leases, we handle those if you need to. We do conservation project updates and CRP information through cover crops and weather reports throughout the year. Our land managers help identify and evaluate and negotiate additional sources of income. That be through tax credits for leasing to beginning farmers, which I know a lot of non-resident landowners want to help beginning farmers start out in business. So we can help you with that. We do wind tower easements with the new green energy bills coming through and all of the different regulations coming down. That's going to be extremely important. Hunting leases are extremely important. We've always said that if you have anything that can be hunted on your property and you don't have it leased out, someone is hunting that property, whether you think so or not. So we want to make sure that we protect you as the client with the correct liability insurances and receive the money that is due you for people hunting your property. We can also do cell tower easements, mineral royalties, manure easements with all of the livestock in a lot of the areas, from cattle feedlots to poultry to hog operations. Manure easements are very good to have in place and can help lower your input costs through the additional use of manure. So we look at conservation easements, wetland easements, and then if you have property that can be developed in rural areas close to urban areas, we look at those and can help you in that area for development also. So as we go through, our managers are always continuing to update themselves by listening and gaining valuable knowledge from leading experts like the panelists that we're going to have today. So before we begin, if you have any questions, please type them in to the question and answer box on the webinar, and we'll get to the question and answers at the end of the webinar. So without further ado, I'd like to introduce Kathy Law. Kathy is an attorney with Nyemaster Goode in Des Moines. Kathy practices real estate law and represents all types of parties with real estate matters, including buyers, sellers, tenants, landlords, lenders, real estate developers, municipalities, and specializes also in renewable energy projects. So she and her husband, Dave, own and operate their farm along with their son, Jonathan. So with that, Kathy, I'm going to turn it over to you and let you take over and talk to us on lease terminations.
That sounds great. Thank you. Let me get this set here on slide view. Okay, I'm going to talk about farm lease terminations today. And let's go to the next slide. So why might you want to terminate a farm lease? For example, a landlord or tenant may want to renegotiate the rent or other terms of the lease. During market changing conditions, you might want to raise or lower the rent. You might want to change the form of a lease from a cash rent to crop share or some type of a flex lease. And you might have to terminate the old lease to accomplish that change. A landlord may want to change its tenant, or the landlord may change. If the farm comes into different ownership, there may be different ideas of who should be the farm tenant. And so ownership changes can also prompt parties to want to terminate an existing farm lease and enter into a new one. So how do you terminate a farm lease properly, or an agricultural land lease? One thing you have to be aware of is that state law, whichever state your land is located in, governs what law you use to terminate a farm lease and what statutes you must follow. So state law may not allow a farm lease to be terminated if it's not terminated by a statutory deadline and using a statutory method to deliver notice to the tenant or the landlord. Some states allow either party to terminate the lease. So you'll want to make sure that you're following the law in whatever state that your land is in. There are several ways to terminate a farm lease. First, the landlord and tenant can mutually agree to terminate the farm lease. Now, this always works. And the landlord and tenant can terminate the lease at any time during the lease period, as long as they both agree to do so. And this is just basic contract law, that the parties are free to agree to something different than they signed up for. Second, at the end of the lease term, you would think the lease typically terminates, but in some states that's not the case, such as Iowa. Because in Iowa, at the end of an agricultural lease term, the lease term automatically extends to the following year unless either the landlord or tenant terminates it according to the time in the statute. And we'll talk a little bit more about that later. Third, the landlord or tenant terminate the lease by the statutory deadline in statutory manner, which would properly terminate the lease. Or if there's a default under the current farm lease, the landlord or tenant may terminate the lease if the other party isn't performing their obligations under the lease. And to do that, you would simply follow whatever default procedures that are in the lease that states what is the default under the lease and how the parties may terminate the lease upon a default. So what we're going to talk about today is mainly just how do you terminate a farm lease, not for a breach of the conditions under the lease, but how can you terminate it at the end of the term or especially on automatic extensions of farm leases. I'm going to go through several states and we'll talk about different lease termination provisions in several of the Midwest states. First thing to know is that in any state, Iowa has a specific state law on agricultural lease termination, and it's found in chapter 562. And I have a wrong reference there. It's 562, not 562A. I should have caught that, sorry. But in Iowa, there are specific code provisions on terminating farm leases. In other states don't have specific language or specific statutes on how you must terminate a farm lease. And in those states, you have to look at the general statutes on terminating just any lease to determine how you can terminate your ag lease. So first, we'll go through some different states and I'll bring up some of the details on how you terminate farm leases properly in several states. So again, in Iowa Code, it's under chapter 562 of the Iowa Code. So in Iowa, a farm lease automatically extends for an additional year if neither party terminates the lease by September 1st of the current crop year. So even if you have a lease that has a 1-year term and it terminates, say, November 1st, which maybe the crops would be gone by that time, that doesn't matter. The parties, even though that language is on the lease, that lease automatically extends for an additional term unless the parties actively terminate the lease. So in Iowa, our law says that to properly terminate an agricultural lease, you have to do that by September 1st. And if landlord or tenant terminate the lease by September 1st, then the lease term ends on March 1st of the following year. And of course, this is to protect the tenant's rights so that a farmer cannot wait until the crop's fully grown and maybe September 15th or October 1st say, hey, tenant, I terminate your farm lease and now I get to take your crops. So if you terminate the lease probably by September 1st, you should always remember in Iowa that the lease isn't actually going to terminate until the following March 1st. So if you're selling your property to a party that maybe wants to build something on your property or wants to farm the property themselves, you have to remember that unless your tenant agrees to an earlier termination, that party cannot occupy the property until the following March 1st. In Iowa, the proper way to terminate an agricultural lease, you can do it in 3 different manners. One is deliver the notice to the tenant or the landlord, because either party can terminate in Iowa, and have the other party sign an acceptance that they receive that termination notice from you. Second, you can personally serve that on the tenant like a process server could do and have the process server sign it or deliver the termination and then sign certification saying they properly delivered it to the tenant. The third way is what most parties use, and the landlord or tenant, whichever party is terminating the lease, can simply terminate, send a certified mail letter, and that terminates the lease. It doesn't matter if the other party ever accepts that letter by certified mail. If you send it properly addressed, proper postage, etc., that lease is properly terminated in Iowa. That isn't the case in other states. Now, Illinois, the notice must be sent at least 4 months before the end of the lease year. And in Illinois, there's a notice to quit form included in the statute that you can use. Now, notice in Illinois, the notice can be given, you can hand deliver a letter to someone over 13, or you can send it by certified or registered mail with returned receipt. So in Illinois, the other party has to actually receive the certified mail and sign for it. In Illinois, oral leases must also be terminated in writing. And Illinois has an exception. For example, if the tenant explicitly tells the landlord that it's not going to rent the land for the next year, the landlord doesn't have to provide that 4 months notice. But we would recommend, making sure you get that from the tenant in writing, and we would probably suggest giving that notice anyway, just to make sure there's no question in the landlord or tenant's mind that the lease is terminated. Nebraska just follows ordinary lease law. It doesn't have specific statutes for ag leases. And in Nebraska, the yearly lease term begins on March 1st, unless the parties agree otherwise, and terminates on February 28th of the following year. And in those types of leases, you have to terminate the lease by 9/1, similar to Iowa. Or also have to be terminated by 9/1. And the statute actually says year-to-year leases have to be terminated 6 months prior to March 1st. So that leaves you with September 1. The statutes require written notice, but Nebraska doesn't specify how that notice must be given. In Missouri, written leases setting a lease term don't require any notice of termination. So if the landlord and tenant agree a lease will terminate on October 1st, December 1st, whatever that date is, that's the date the lease terminates. Now, if you have a year-to-year lease or an oral lease, that does require written notice by the landlord or tenant at least 60 days prior to the end of the lease term. Minnesota, it also relies just on general landlord-tenant law. You have to give the notice in writing. And the time of the notice that you give in Minnesota has to be at least as long as the interval between the time the rents are due, or 3 months, whichever is less. Kansas, the parties can agree in the written lease how to terminate it, and the notice must be given in writing at least 30 days prior to March 1st and must fix March 1st as the termination date. Also in Kansas, they have certain statutes. If it's fall seeded grain, the leases have to be terminated in certain manners if there's fall seeded grain. And then in those cases, the leases terminate on whenever the crops are harvested on August 1st, whichever comes first. I think the last state I have is Indiana, and Indiana has a year-to-year tenancy, requires written notice to terminate the lease at least 3 months before the expiration of the lease year, unless the parties agree otherwise. So in Indiana, the parties can agree to a different termination date. If a lease expires at the end of the calendar year, notice must be given by October 1st. And then if you have a lease that expires at the end of a custom crop year, the notice must also be delivered by December 1st. And in Indiana, they don't have specific statutes, but courts have ruled that oral notice isn't sufficient. You have to terminate in writing. Wisconsin, there's no specific statutes on ag lease termination, so you have to look at general tenancy laws. And in Wisconsin, unless otherwise agreed, a year-to-year agricultural lease requires 90 days notice before the end of the lease term. And I'll be happy to answer your questions at the end of the presentation. I look forward to those. Thank you.
Well, thank you, Kathy. We'll move forward with our next speaker, and our next speaker is Dustin Johnson. Dustin has over 14 years of experience working with large agricultural producers through the Midwest and the Delta region to help mitigate farm price risk. He's been integral in helping design the Ag Yield software program that helps manage farm margins. Takes the guesswork out of the marketing plan by using farmers' actual information, and Ag Yield can help pinpoint risk areas in order to create, execute, and monitor strategies to mitigate risks. So with that, Dustin, I'm going to turn it over to you to talk about the grain markets.
Okay, great. Thank you, Dave. I appreciate it. Can you see my screen okay?
Yes.
All right, good. So thank you for the introduction. We do a lot of work directly with growers where we're working on fine-tuning revenue, no matter what that yield or what that price comes out to be. We know that there's a very large yield and price relationship. I'm going to talk about that at the end because it's really pertaining to 2022 and this cost production hike that we're all expecting and what the average grower that we're talking to is kind of dealing with and the decisions they're making. I did want to talk about a few points though leading into that. I think that we want to just put ourselves into that, into that perspective of how we got into the situation, why we're here, the financial health of the producer. We have some concerns about the longevity of this bull market right now. And, anytime that we start talking about much higher prices, usually what we hear from producers is concern about instability on that profitability, large cost production increases followed by input or production output losses at a later date that can cause some real pain. And we're all too aware of that coming out of, from 2013 to 14, what we experienced from 15 through 18. So the next biggest things that, kind of a provocative topic is biodiesel. Some of the gambles that were going on about that longevity of where prices are, and then we'll lead into that 2022 example. All right, so as a visual, I think that it's really easy to kind of see, how we got into a little bit of a tough time for producers. This was not really a fun time for marketing after, that 2008 to 2014 period. So this is just a chart of corn, wheat, and beans combined. And it's just a simple way for us to show how good of a price we are compared to history for the average row crop producer. And more importantly, how long these prices usually hold. So we're coming out of this 6-year stretch of really negative prices. And we're about 20 to 37% lower than what we have been experiencing. And that was really the maturation of the mandates, the hangover of when we finally started to produce enough crop to kind of account for some of the deficits we had stepped in, and we got used to those prices, and our cost production got used to those prices as well. Now we're jolted back into that market right now, and it's been about 23 weeks of this favorable time frame that we've been working with. So this has led to a huge improvement on grower margins. From our quick stats, this is just a year-to-year comparison. Last year we're trading down in the low 330s for corn. We were sub $9 beans at this time last year. If we remember, this is really the day of the low is right about now, is right before derecho struck in Iowa. So our scores were very low. Our ag yield scores were in the 6s and the 5s. And just think of that on a scale of 1 to 10, proximity to profitability. So a big portion of our growers were likely to be losing money, and that's including crop insurance, farm bill payments, everything else. At current expected yields, there's a big portion of growers that are expected to lose a lot of money. Flash forward to today, and we've got an average score of 9.7 for corn. This is out of 10, and 9.2 for soybeans. So we're in a much healthier situation for the typical client and grower that we're working with. That's led to a higher sales pace as well. I think everyone's feeling a lot better about selling $5 corn than when we were at $3.50 corn. And this is all on 2020 cost production. We really didn't see too big of a rise of cost from our book, at least about 2.5% increase from 2020, which has led to what should be a pretty good liquidity injection for the average grower. This is obviously not the case for every grower because there's certain places that are experiencing some weather issues right now. But for the typical grower, we're seeing a really good sized liquidity injection. All right, so why is this the case? Well, there's a number of things that lead to bull markets. Most of the time it comes from the supply side, and we did have some problems in Brazil this year. We had some problems last year with our own production. It was below what we were expecting at this time last year. But I think the biggest thing is that China overnight became the world's largest importer of corn. And the fact that their demand had lagged due to the trade war and the fact that they were not buying from us for an extended period of time, they needed to come back in. They stretched that rubber band a little bit too far and needed to come back in and refill their coffers, right? Refill their supply as they're experiencing major commodity price inflation. And that's one of their main goals, is to try to tamper that inflation, which they've been doing a pretty decent job at. So we're expecting similar type of demand next year. The USDA is out of China at least. And this is next year's sales on the books. And we saw as soon as Brazil started having a problem, we led right into massive Chinese purchases in a 2-week window in the month of May. So they've already got a ton on the books. Since then, they've been quiet, for corn at least. They've been starting to buy more beans. So a pretty strong demand story. And it looks kind of funny right now. If we look at where Chinese supplies are, they're still telling us that they're holding on to 68% of the world's corn supply at the moment. Yet they're the world's largest corn importer overnight. There's clearly a bit of a mismatch on what's being reported and what's actually there in China. So we chalk that one up to the positive one, positive side of why this thing could be supportive for a few years to come. But then again, we start talking about South American currencies, Black Sea region currencies, and then Black Sea region production ability. And now this is where we get a little bit cautious. And we're talking long-term price increases for our producers. How are we going to match that output, that revenue, to account for that cost of production increase? This is just a simple chart of backing into what the price is per bushel for US beans in blue versus taking it back to the Brazilian exchange rate, right? If we were to take it back to their exchange rate going back to 2006. From 2006, we've seen a pretty good size doubling of price. From their perspective, though, that's almost like more like a 5 times or 6 times price. Their currency rate has been very favorable for their production expansion, and we expect that to continue. Their prices are off the chart. If we think our prices are good, they have every price incentive to do that. And the same thing goes for the other emerging market currencies, Ukraine, Russia. This is just total Black Sea corn and wheat production combined. It took a long time to get back to where we were back in 1978 when the fall of the Soviet Union to where we got to in the last decade where they started to match that production again. Now they've really kind of hit the gas on their production ability. We just don't want to fall into the trap that we're back into this 2012, 2013 situation for prices, when we have to take into account that the rest of the world is much better growing crops than it was the last time we were in this price range. Just something provocative to talk about. If it's not Chinese demand for the long-term support of the market, it would likely be coming from biodiesel. Second generation biodiesel is going to be a huge thing. We've already seen some major disruptions in the single year that we're starting to see some of these plants come on board, including the one in Louisiana this year. This has led to a complete flip-flop of what we crush for right now. So here's the Soy Complex. We're looking at beans in gray and soybean oil in blue. We've had a massive 60% increase in the price of soybean oil since the beginning of the year, where beans are up about 20%. So how is that the case? It's because meal has been the laggard of all of them. Meal is really kind of the byproduct of the soybean complex at the moment. So meal users, this is great. We've got low prices compared to what we normally would be experiencing in a supply deficit. But it's something that is really hard to see hold on to for a long period of time unless there's some sort of government incentive. So this is where we're getting into this oil share, where we're now crushing for oil, and it's continuing to be the case as we look out into 2022. Just watching those incentives, those biodiesel credits that we're seeing, how that changes where crops shift from corn over to beans. We think by the year 2025, we're probably going to need to see another 8 million acres of beans to satisfy this. So something to watch for in the next couple of years. Going to be mainly supportive beans, I think, over corn. All right, so last, real quick, example of what we're dealing with for producers. They're looking on average right now, $80 to $100 an acre an increase in cost of production. So if we're going to take last year's cost of production and just add $80 on top of it, it's going to be kind of hard to read, but we can go back to these slides later when they send these out. If we fall back down to 415 prior to the insurance price being set, we think there's a good chance that people are going to be underwater by about that $80 an acre. Okay, so if we do nothing right now, and we see that the Brazilians come in with another big crop, the Russians, the Ukrainians come in with another big size grain crop, and China had a decent crop, there's a chance that we revert back to the mean price that we've been experiencing. And that would be disastrous for the cost production increases that we're expecting for the grower. So some minor changes, even just some simple marketing going into the year is going to make a big difference. So here's, if the spring price holds at least 450 and the grower sets its first 50% of production at 450, about half of that $80 an acre of risk at standard baseline yields would be covered, about half of that. If we go market half today though at $5, all of that would be covered, all of that increase, right? So that's the first 50% of sales would cover that on like for this example, 220 bushel grower would cover that increase. And that's something we're trying to be very, forthcoming with producers saying, hey, we know cost production increase is coming. How are you going to pay for it? Right? As we're signing these leases for the next year, that's something that we're really encouraging people to start considering. I think it's going to be more important as we get towards the end of the year as well to do that. So I'll be happy to answer any questions about how we came to these numbers at the end, but that's my presentation. Thank you.
Thank you, Dustin. Appreciate that. And with that, we're going to move on to our next presenter. And he is one of our own here at People's Company, and his name is Peter Isaacson. And Peter joined our company back in 2018, and he focuses on land as an asset management and does it through the upper Midwest. Peter is well versed in utilizing multiple forms of land leasing arrangements, as well as custom farming, organic farming, and doing complex leasing structures to maximize value for both operators and non-resident landowners. So Peter's background and passion for production, agriculture, and conservation make him an important member to the land management team and a great resource for landowners and the clients that he serves. So with that, Peter, I'm going to turn it over to you.
All right, let's see if I can get my screen pulled up here. Okay, can you guys see my screen all right? Can you see my slides there, Dave? Okay. All right, so Dustin teed me up pretty good for this. I'll keep my market update short as far as commodity goes. But today we're going to talk about cash rental rates, what's currently driving the market, leasing alternatives, and selecting the right farm operator for your farm, using data to make decisions, determining a fair value cash rental rate, and what landowners can expect to see for 2022 farm leases. And then we're going to talk about a little bit about leading harvest. I'm sure many of you have heard of leading harvest, but what does the certification entail? What does it mean for your farm? Why should you care? And how can your farm become certified under leading harvest? So that will jump right into the markets. So, the prices we're seeing today have a lot to do with 2020. We had a dry year in Brazil. We had some drought in the Midwest, and a year ago today, we had the derecho. 2021, the upper Midwest is struggling with drought. 71% of Iowa is currently in at least a D1 drought. So we're kind of living rain to rain right now. Decreased supply and increased demand for fiscal year 2021. Corn exports from 2020 to 2021 are expected to increase 23%. And a lot of that's going to China to feed their recovering hog population. And then a low river system in Brazil that's really keeping a lot of their grain trapped. So, U.S. exports are really taking over, and a lot of our corn's going over there. So when we talk about farmland leasing, a lot of people think of a fixed cash rent lease, which are great. We see a lot of them in the Midwest, but there's other options out there. And you can see on the right-hand side the risk spectrum associated with these leases, and the highest risk, but right now the highest reward would be custom farming. The landowner pays for 100% of the inputs, hires a local operator to plant, spray, and combine, and the landowner sells that crop and they take all the proceeds. So those do really great in an environment like this, but carry a lot of risk. Second one's a crop share lease. These used to be pretty common in Iowa. We're kind of seeing them fade away a little bit, making room for fixed cash rent leases. But in this scenario, the landowner provides the land, local operator provides labor and equipment, and expenses are typically shared, and so is income. There's a lot of different breakdowns you can do with that. You can do 50-50, 40-60, 80-20. So it really comes down to crop types and where you're located and what you want to do with your operator. And then something we're really seeing take a lot of steam is a flexible cash rent lease. So these are popular, work really well in a year like this, where the landowner takes a base rent. They're guaranteed that at the beginning of the year, and then based off their price and yield, sometimes there's a revenue trigger price. And when your gross revenue per acre exceeds that trigger price, there's a percentage that's paid out to the landowner following harvest. So really like those. When we were negotiating rents in January, corn's at $4. We were negotiating our rental rates on that price. And flex leases, they're going to have an additional payment this year along with that rent we collected up front. And then the last one, most people are probably familiar with this one, but fixed cash rent lease, operator makes all decisions, they get all the crop, landowner collects their rent up front, and that, pretty hands-off, pretty low risk, very common. So something that we don't talk about a lot, but is really important, is selecting the right farm operator. And this is really what we look at People's Company. When we're going out there looking for a new operator, these are the things we're looking for. And we want somebody who's willing to share input and production data. So we want to know what they're doing for fertility, what they're doing for management, what their yields are, and that's going to kind of help us gauge that farm. Ability to meet and execute on the goals of the landowner, along with shared vision of preferred production practices. If you want your farm to be farm no-till and your operator hates no-till, that's probably not going to be a good relationship. So you guys need to have a shared vision and really be on the same page. Financially solvent, pretty simple one. If they've got a lease payment of $100,000, you want to make sure they can pay that payment. Timeliness of operations, if they're planting early, they're combining on time, all that sort of stuff, that's really going to lean into profitability and just, making sure that things are being done right on that farm. Trustworthy and honest, if you're in a crop share custom agreement, can't express this enough, you want to trust that guy. If you're sitting down at the kitchen table negotiating rent, you want to trust that person across the table from you. And then responsiveness when contacted. You don't want an operator that takes 2 weeks to get back to you. You want to be able to have a transparent relationship with them and be able to contact them whenever you want. And then openness to signing a written lease. We think a written lease is almost mandatory at People's Company, just because it eliminates any confusion. It outlines everything in writing. And if there's a question, you can refer back to the lease and you can answer it pretty simply. So when it comes to determining fair market cash rent, there's a lot of things we look at. A lot of times we start with the county average, and then we look at your farm specifically. So do you have above average soil types, below average, above average yields, below average? Farmability, if the average farm in your county is a flat square 160 and your farm's 5 different fields that equal 100 acres, it's probably not going to be worth as much as a flat square 160 just from a farmability standpoint. And then farm improvement or outstanding characteristics. This could be pattern tile drainage. This could be a hog confinement on the property. This could be a manure easement, things like that. And then we're looking a little deeper into production history, fertility records on that farm. So if it's got average soils but above average yields, that's something to take into consideration, or really high fertility. Then crop types and production practices, certain crops and production practices such as organic will fetch higher premiums in the marketplace, higher gross revenue, higher rent. And then input costs, Dustin mentioned it, we're really watching input costs this year. Prices are up, but everything else is following. Seed, chemical, fertility, land values, rents, those are all going up too. So you want your operator to make money. And then commodity prices, it's kind of important to, just because they're going up right now, which way are they moving? How long can they stay there? Are they stable and are they sustainable? And is the same thing, can the same thing be said about your rental rate? Is it sustainable if markets move back down? So those are really the things we're looking at when we're determining rent. And then just kind of a 500-foot view as we terminate leases and go into renegotiating. Corn since the fall 2019 is up over 50%. Soybeans are up 62%. ISU rental rates are up 4.5% as of May 2021. This is probably a pretty good lag. If we were to redo that survey today on what guys are negotiating for 2022, I think we're going to be in a 15 to 25% increase. That might not be recognized on the ISU survey, but we'll see. And so far, 2022 is looking to be a pretty profitable year for farmers already, despite, you'll have to keep an eye on inputs and that sort of thing. But futures price for board 22 is for corn is 5.16 and soybeans are 12.51. So there's some marketing opportunities there. You obviously have to account for basis, which is going to vary where you're at in the state, but there's profitable marketing opportunities at this point. Then we'll jump into leading harvest. Sustainability, huge buzzword right now. If you corner somebody and ask them what it means, you're probably going to get a different answer from every person you talk to. So leading harvest is a coalition of environmental organizations and companies that manage, operate, and invest in farmland. And this is a pretty broad sustainability initiative that can be implemented over different regions, crop types, and even continents. So it's open, it's living, it's adaptable, and it uses these 13 principles. And this is really what the standard is based off of. And it's everything from sustainable agriculture, conservation, air quality, to local communities, how you're using your farm labor, government compliance, that sort of thing. So when you ask how Leading Harvest defines sustainability, you can look at these 13 principles and back that into your farm and your operation. As far as what Leading Harvest means to landowners, I kind of look at it as a Carfax report for your farm. If you're a land buyer and you're going to buy a farm, you know exactly what's been done to that farm, how it's been managed, who's managed it, all that sort of thing. It's kind of a full scale, record keeping system and a set of parameters that farm is managed under. It addresses unique needs regardless of crop types and regions. Like I say, it can be implemented over a broad region or continent. Buyer assurance through the transactional process, just because you know what's been done on that farm and how it's been taken care of. Continuous framework for improvement. It's a living standard. We're always working on it, making it better and applying it to that farm. Preservation and improvement of resources for future generations. Population's not getting any smaller. We need more ground. We need to be productive. We're not making any more ground. We need to maximize production on what we have in a sustainable way. And then the management, auditing, reporting handled by Leading Harvest certified vendors. So, there's that fact checking aspect to it. And then one we're kind of excited about is potential for marketplace premiums, as end users and processors are really looking to source sustainable products. And this kind of gives it a backing and identifies what sustainable is. As far as having your farm managed under Leading Harvest, People's Company is the only private management company in the United States offering Leading Harvest certification to landowners. And all of our acres for 2021 are enrolled in the standard. So if your farm is actively being managed by us, it is currently enrolled and being managed under those 13 principles we talked about a few slides back. So, if Leading Harvest is something you think is right for your farm, we're the company to get in touch with right now, and we can carry out that. And then an overview, 2021, 2022 commodity prices are pretty favorable right now for producers. We've got some supply concerns. We got low ending stocks from last year. We've got drought that's kind of deteriorating some crop in the upper Midwest. we're expecting to see input costs rise, seed, fertilizer, chemical, that sort of thing. So you're going to have to keep an eye on that cost of production when you're negotiating rent as well. But, like I say, 500-foot view, 15 to 25%. It's going to be very farm specific, but that could be a general rule of thumb. Know your operator, get leases in writing. If there's anything specific or out of the standard characteristics of a farm lease, outline it in the lease. Then you've got a signature on it. Everybody knows their obligations. And highest rent isn't always the best rent. Years like this, everybody can pay high rent, but just because it's the highest doesn't mean it's the best. Just because they can pay it doesn't mean they should. And sometimes those guys paying the highest rent are cutting corners a little bit. And you just got to make sure it's equitable for everybody. And Leading Harvest, People's Company is a premier management company to offer to landowners in the U.S. Buyer, landowner peace of mind throughout owning or buying a piece of ground. What's being done on it, how it's being handled. Flexible standard that can be applied globally. That's huge. As the industry looks for something to latch onto, it's got to be adaptable. And this standard is. Then the opportunity for market premiums when selling farmland or crops, I think that's down the road, but on the way. And then we've already got 2,000 acres committed, or the standard does, with 50 organizations consulted to develop the standard. So it's not narrow hallway type approach. A lot of thought went into it, a lot of different people with a lot of different perspectives that helped to develop the standard. So it really can be suited anywhere, but that's all I have. And if you have questions, leave them down in the comments, and look forward to hearing the other speaker today. So thank you for your time, and look forward to hearing from you.
Thank you, Peter. Appreciate that very much. And for our last speaker today, I'd like to introduce Adam Keel. Adam is the Executive Vice President of AgOutcomes, a subsidiary of the Iowa Soybean Association. In this role, Adam co-administers the Soil and Water Outcomes Fund, which is a carbon and water quality ecosystem service program. He has over 20 years of experience in the field. So with that, Adam, I'll turn the balance of the program over to you.
All right, thanks, Dave. Thanks for having me today. I'm excited to kind of share some of this new and innovative opportunities for farmers as they embark on conservation additions to the farm. So I know we're short on time, so I'm going to go through this rather quickly and leave time for questions. But the point of my talk today is to expose you all, whether you're a landowner or farmer, to what some of the opportunities are around ecosystem service markets or carbon markets, as you probably heard about if you followed anything in ag news recently. So first, a little bit about what I do with the Soil and Water Outcomes Fund, and this is kind of pulling back the curtain a little bit on a carbon and ecosystem service program to help you understand how they operate. Most of the programs that you've heard about possibly operate in a similar fashion, so I thought it'd be good for you to hear kind of how things work, and we'll go through this here for a few slides. So first, the Soil and Water Outcomes Fund, we provide financial incentives to farmers who implement new conservation practices that produce environmental outcomes. We'll get into what those outcomes are here in a second. And then we aggregate and sell those environmental benefits to public and private beneficiaries. So we've got customers that include all levels of government, whether it's county, municipal, state, federal government purchasing outcomes from us, as well as a number of private corporate partners who purchase from us as well. So we work with farmers and landowners to produce two environmental outcomes, and they fall into two categories. One is greenhouse gases, or to use an overused term these days, carbon. But when we market and sell carbon, we're selling not just soil carbon sequestration, but we're also monetizing the nitrous oxide reductions that result from conservation occurring on the farm. Those primarily are being sold right now to corporate partners who have made science-based or net zero commitments as it relates to their scope 3 emissions. And we market directly to those companies that have a fixed price that we offer to farmers and to our corporate partners. Just a side note, we do anticipate the price of carbon to hopefully increase over time. Right now, it's probably not at a price point that's going to get too much attention from farmers if it's a carbon-only program. And part of that low price is why we've worked to incorporate water as a secondary ecosystem service that adds value to farms and the conservation they implement. So we monetize also the water quality improvements resulting from conservation, and specifically the nitrogen and phosphorus improvements to water quality. As I mentioned, we sell those outcomes to mostly public entities who use them for either voluntary or regulatory uses with water quality permits or just a municipal water quality stewardship effort. We do have a couple corporate partners that are interested in buying water quality outcomes, but most of the attention from the private sector today is on the carbon side of the ledger for us. How do these programs work? This is how we operate, and I'll be sure to highlight some of the differences here quickly. So the Soil and Water Outcomes Fund, we enter into contracts with farmers and landowners who implement new conservation practices. One difference about our fund is that we provide 50% of the payment to farmers at the time they sign the contract. So we have farmers enrolling right now in programs that are going to implement conservation this fall and winter. They're receiving checks to help with some of those upfront costs. Once we have farmers under contract, we undergo a pretty rigorous monitoring and verification program that includes soil and water sampling, remote sensing, and field visits by some of our agronomists. That helps us verify that farmers and landowners are producing the outcomes that we estimate they are. Once we've got those outcomes verified, then we transact with our customers, those public and private entities that purchase from us. The revenue from that sale then replenishes the fund, and we can grow and operate again in future years and continue to make those payments to farmers so long as we have those outcome purchase commitments. That's how we operate. Others in the space, in the carbon space, may have a different approach to when they pay farmers, and I'll get to some questions that farmers and landowners should ask as they explore some of these programs here in a few slides, and payment is one of those things to really drill into. Where do we operate? As Dave mentioned, we started as a spinoff of the Iowa Soybean Association, so we started our work in Iowa, and that's where most of our operations lie today. But we also operate in Illinois and Ohio and some Chesapeake Bay states there, which you can see out east. We hope to be expanding here in 2022 to include additional states, likely Missouri, Indiana, and North Carolina. And just a little bit more about our interaction with farmers. We enter into 1-year renewable contracts, and our average payment this year, when you look at the water and the carbon together, has been right around $35 per acre. So it's not a get-rich scheme here in terms of conservation, but every little bit helps. And $35 we find typically covers about all the costs, if not a little bit extra to account for some of the risk with conservation. So we feel pretty good about our price point in comparison to some of the other carbon-only programs, which tend to be in the upper single digits to low teens per acre per year. So by adding on that water component, we're able to offer a higher payment for farmers. We don't have any sort of acre limits currently. We do have a pool of acres that we feel like we can service, and we don't want to exceed that. But as far as an individual farmer, we've got a farmer in Ohio who enrolled 8 acres, and we've got a farm in Iowa that enrolled over 10,000 acres. So we can handle any size farm, and we're happy to serve those small farms just as much as we are those large farms. As I mentioned throughout my talk, there's many other programs that are emerging out there, whether it's a carbon program or an ecosystem service program that encompasses more than carbon. You're seeing these pop up every day. These are just some of the ones that are out there right now. And there seems to be additional carbon or ecosystem service program opportunities every day. So what we try to do here is provide guidance not only to farmers who enroll with us, but also want to give some advice to farmers and landowners who are thinking about enrolling in any of those other programs, the web address down at the bottom of the screen provides a more robust list of the questions that I'm going to go through here right now, but developed a list of questions that I would encourage folks to ask us as they're looking to enroll with us or any of the other programs. So go through these quickly and then we'll have time for questions. So the first question is that you should ask is, can I enroll fields with existing conservation or do I have to do something new? We have a requirement that new practices be added to any acre that enroll. So for the 80,000 or so acres that we're enrolling in Iowa this year, those are all seeing new conservation practices. Most of the conservation is reduced tillage or no-till and the addition of cover crops across all those acres. So not every program operates the same, so it's important to understand where you fit and what's best for you. Can you enroll in other programs at the same time? That's important for us. You can't, but some allow you to enroll in USDA programs at the same time you enroll in a carbon program. An important aspect of enrollment with any of these programs is data, and understanding of what data you need to provide is very important. As a landowner, you may not have access to all the data you need to enroll, so hopefully you have a good relationship with your tenant and you can get that information that's necessary to enroll. You have to own the fields, or can you enroll rented fields? That's different based on the different programs. With us, we do allow rented fields to be enrolled so long as the applicant who's enrolling has control over the decision-making powers that happen in terms of the farming operation. As I mentioned, the payment terms of the contract are very important to understand. When are you paid? How much are you paid? Are you guaranteed payment? Those are all important questions to ask. Some of the programs, I've heard some horror stories about farmers waiting 2 years to be paid for a carbon payment. That's not what we want to see. We have a different approach to payment that's pretty farmer friendly. And lastly, and most importantly, what are you being paid for and what are you transferring ownership of via the contract? Some programs are paying for the carbon benefits, but are acquiring every ecosystem service. So it's important to understand what you're being paid for, what you might be missing out on. So read those contract terms closely. Down below there again is the web address for more resources here and more robust list of questions to ask. So with that, I'll wrap up, Dave, and we can get to the questions that folks have. Thanks very much for the time.
Sounds good. Thank you, Adam. That's the end of our presenters for today, but I see we've got a lot of questions. We've had a lot of questions both today and from previous submissions before the webinar started. So we're going to dive right into some questions here. I'm going to start out with at least one question per panelist to get started. And if we have some more interest, we can carry on just a little bit longer. So with that, first question I'm going to start out with Kathy is, do you have to have a written termination even if a lease is for a specific period of time with a defined ending date?
Well, again, it depends on what state you're in. For example, in Iowa, you have to, the termination date is still, the lease automatically rolls over to another year. Some states that date's definitive.
Okay, thank you, Kathy. The next question would be for Dustin. What is the yield point that could signal a downward trend in prices?
Good question. I would say that we're already trading a sub-trend line yield by about 3 bushels to some degree. But we have to remember we're at $5.50 corn and over $13 beans. And typically this time of year, we're at, sub $10 beans and $3.30 corn. So I would argue that naturally producers are going to start selling as they know they have a crop. And it could be that a 160 or 176, 177 yield does result in a 475 price for corn and a 12 to 12.50 price for beans. So I think that naturally we're fighting the time where producers start naturally selling. And when we're talking to our clients, that we want to make them aware of that.
Okay, thank you, Dustin. This one's for Peter. What are the main components that are taking into consideration of getting a leading harvest certification?
Yeah, so the main components for that would really fall under the 13 principles of the initiative, and just making sure that they can be applied to that farm, selecting an operator that's going to go along with those, and making sure that they're implemented with, third-party verification and farm visits and auditing process. So the 13 principles would be the main components.
Okay, thank you, Peter. This question's for Adam. Do you know how long it takes for our main crops to see the benefits from cover crops?
Yeah, I would say probably 3 to 5 years is probably the typical range that we hear from farmers being getting out of that dip of profitability, but could be sooner, could be later, depending on how the farmer's managing that. But that typically is the dip that we see is a couple of years.
Okay, we'll take a few more questions. Thank you, Adam. This one again is for Kathy. Does an email verified by a tenant's response qualify for a notice of termination?
That's arguable. Even in Iowa, for example, the statute sets forth certain ways notice has to be given, and email isn't one of those. There have been court decisions in some states that have allowed that, where the tenant acknowledges the lease is terminated. But again, I would really stress following whatever the state statute says, just to be sure.
Okay, thank you. This one's for Dustin. Dustin, do we see China continuing to buy commodities at their current pace well into next year, or do you see that subsiding a bit?
Oh, that's a good question. I think that China is very opaque in what they do, and I think what they have done is they secured enough needs to get through it. I think if they do come back for it, it's going to be after we get through kind of a gut slap period of harvest in the U.S. They're price sensitive, just like anyone else. They're trying to get the best price for what they're doing. And that's part of the reason why we've got such opaqueness on the numbers that they're reporting, I think. So I would guess, because Brazil's having a big problem this year for production, that China will come back for more U.S. corn. But some of the lofty demand goals that are out there, we're going to be on the lower end of what people are expecting. So I would say we're kind of negative on the corn front because of China.
Okay, thank you. Next question is again for Peter. Can people use the Leading Harvest initiative to force a tenant to comply for conservation and sustainable practices?
I don't know if you can force a tenant to comply, but if your tenant is not complying, they're probably not the right tenant to be certifying under Leading Harvest with. So as far as, if a lease is in place and certain things are outlined in that lease that don't pertain to Leading Harvest, you don't really have any means for termination or enforcement. But if the principles and, responsibilities of the standard are outlined in the lease, after they or before they signed it, they should be well aware of what they're getting into. And at that point, I would say it isn't enforceable. So.
Okay. Thank you, Peter. Next question is for Adam. What are some of the new conservation programs that USDA is considering, and when might we get more details regarding practices and compensation?
Yeah, that's a great question. As folks have probably heard, there's seeming to be a lot of chatter around carbon programs coming out of USDA, but there haven't been too many details yet. I would anticipate there'd be some announcements coming, or some new programs coming once we get through some of the infrastructure discussions and talk about the Biden administration budget. So more to come, but I think there will be some changes in the way programs are administered at USDA to focus more on climate issues.
Okay. Well, thank you. I think we've run over our time just a little bit, and being time sensitive for everybody, we're going to end the webinar right now. And I'd like to thank our speakers again for their time and information. So thank you all for joining the webinar, and it was our pleasure to host it. I hope you've gained valuable information and insights. So if you'd like to subscribe to our website at peoplescompany.com, you can get our most up-to-date information and when our next land management webinar will take place. If you're interested in farm and ranch management services, please email us at landmanagement@peoplescompany.com or call us at 888-800-land. A copy of this video presentation will be available to everyone tomorrow on the People's Company website. Until next time, have a great week and stay cool. Thank you.